What's up, everybody? This is Jimmy with Trading Decoded, and today we are going to talk about gaps, what they are, and how we use them to make money. So what you have in front of you here is the last 6 days of trading that have taken place in the S&P 500, or SPY, which is what we focus on here in our Discord, in our group, in our community. What I've done here is broken out each trading day into separate colors to make it easier so we could see what we're looking at. The red section here is from Friday of last week, and then we go into Monday, Tuesday, Wednesday, Thursday, and the Friday that we just passed. Each bar here indicates where the gap is in relation to where we are opening on this trading day. So what is the gap? The gap is where we closed at 4 o'clock on the previous trading day in relation to where we open the next morning. So in this case, this was from a Thursday of a week ago. And let me blow it up so you guys can see what's going on here. So this here was a small gap. I actually have this in the wrong spot. Should be at the top of the candle here. So this red line here, the vertical one, indicates market open for this particular Friday, which happened to be January 21st, 2022. The previous day's close was here at this thin red line. So in the mornings when I make my Spynalysis, which I do every morning for my Discord members, I always mention the gap. And all the gap is what we closed at Thursday, which was right here, versus where we open on Friday, which was here, top of this green bar. Now in this particular case, it wasn't a very large gap. We opened at 445.59, sorry. And then the gap was at 446.81. So when I say we have a gap above us, that is what I'm referring to. Now, the thing about gaps is there's a very strong possibility that SPY will fill that gap, meaning we will get to that price at some point in the day at a pretty high frequency, meaning the percentages of it closing the gap on a daily basis is very high. Is it guaranteed? Of course not. Nothing's guaranteed in the stock market. Do they eventually always fill? Yes. Could take a day, could take a week, could take a month, could take a year. But gaps seem to always get filled at some point or another. However, historically, the daily fill of a gap is usually pretty high probability move. So in this case, albeit the gap wasn't huge, you can see that we opened here and we only needed to go here. But we happened to dip down that day. We reversed. And then by 10:50, a little over an hour after market open, we filled the gap. Anything could happen after that, but as you could see, we filled the gap and then we just ran down for the rest of the day for the most part. Let's move on to Monday, the 24th. Now, again, these vertical orange lines represent the open and close of that particular day. And in this case, we have a massive gap down, okay? Which means Friday, we closed up here at this orange line, and then we opened the following Monday after the weekend way down here. Now, in this particular case, it took all day to fill the gap, but we filled the gap. As you can see, we opened, we chopped down a lot, we chopped up, we came up, and boom, 10 minutes before market close, maybe 15, either way, we fill the gap. It's almost guaranteed But in this case, it happened. Let's move on to Tuesday. So on the previous Monday, we closed all the way up here. Okay. Again, we gap down Tuesday morning. We open up here. We chop around all day, all day, all day. And then bam. In this candle, we actually filled the gap at 2:50 in the afternoon. Nonetheless, we did it. Let's move on to Wednesday. We happen to gap up on Wednesday. So we closed down here the previous Tuesday, and we opened up here. Chopped around all day. Once again, we fill the gap right here on this candlestick, just at 2:45 in the afternoon. Boom. We'll move on. I'm not going to explain what each line is, but you can see we open here, gaps down here, we fill the gap right here, 12:30 in the afternoon. Let's move on to Friday. Now this one was weird because there wasn't much of a gap to begin with, but we did close on this blue line on Thursday. On this particular, which was at 431.16, and on this particular candle, we happened to open at 432.68, so up here. And then on the very first candle, we closed the gap. Boom. So we ran up, we hit it a bunch of times, but either way, the point I'm making is many of you may not understand what the gap is. Many of you get confused because a lot of people have the pre-market and aftermarket data on their charts. I turn them off because they don't matter in relation to the gap. Gap rules are that most of the time they are going to fill. And so when I mention the gap, that's how we play it. We basically say, hey, we gapped up or we gapped down overnight. The chances of filling are high. So worst case scenario, if you were to buy in the direction, let's say you bought up here and we know the gap's down here. If you would have bought puts anytime, you would have made money on this particular Thursday. If you would have bought puts here and held, you would have made money when we hit here. You bought calls down here. Let it run. Now, theta would be eating away at you, but this is a pretty big move. I mean, we went from 433 and the gap was all the way up at 439. So I don't care how much theta decay there was, you're still making money here. Again, you would have bought calls here. Now, this one would have been a tough day because you would have been red in your calls. But again, you know, we went from 432 up to 437. That's a 5-point move. These would have paid out too. A little bit less because of theta decay, but still, we filled the gap. And again here, red line was the gap. If you would have bought calls, even here, come down here and it fills. Now, there's something important that needs to be said. A lot of these runs, if you would have bought at open, let's say you bought calls here, it would have been bad decision making on your part to hold those calls all the way down to here. I mean, the way I teach you guys how to trade, you really need to be cutting your losses way before we get the hell down here. I mean, this is absurd. If you would have held from 432 all the way down to 420, I mean, that's absurd. I mean, that's ridiculous. You can't do that. It's better to play smart, wait for confirmation. So if we know the gap is up here, for example, and we don't want to play the open right at open. I mean, especially if you have a smaller account and you have limited trades because you're not on a cash account or whatever the case is, wait for confirmation. I tell people this all the time, and for whatever reason, people always want to try to anticipate or get the entire move, okay? In this particular case, once you put in a high like this, you know, close to open, what happened up here was there was enough selling pressure to stop SPY from moving up. Okay? When that happens, it starts to drop. It starts to drop. And as you see, all of these candles with these massive wicks on top, that's SPY trying to move up and then keeps getting pushed down. Now, when you get smaller wicks at the top and bigger ones at the bottom, that's indicating that there are buyers down here willing to put in the money to stop the continuation of the drop. In this particular case, we had a big wick. You could have used that as an indicator of possibly a reversal. That's if you're playing risky. That's if you're playing tight, meaning you're going to cut if you're wrong immediately. But let's just say in this case, you bought a call on the next candle. It worked out until it didn't. So if you were to have bought a call here and you're trying to scalp, you got this here, which is a pretty positive candle because there's nothing up on no wick on the top indicating that somebody's preventing it from moving up. But once you get this big red candle printing, you're going to want to cut once you break above these guys. And at the very worst case scenario, if we break below here, okay, because it really depends on where you bought. But at this point, there's no more support holding it up. We're not going to get into the how to trade this. However, the safest bet if you're playing the gap would have been you don't get into a call until we break this previous high of day right here. Even if you had to exercise ridiculous patience, you could have bought your call literally when we started these wicks touching up in here. And what would have happened? You would have caught, if you would have bought the minute we broke through that high the first time, right here, would have been right here. Let's just say you bought at 433.50, your call. We fill the gap, we still run up. You know, you're talking a 6-point gain. Do you have any idea how much that call would have printed just in that short amount of time? But the reason that this worked was because you got to look at it like this. And we've talked about this in the Discord. So I know you guys know, but you're too impatient to wait for the move. When we got here, we had a bunch of shorts keeping it down all day. And you got to understand that the people up here are making money as long as we're below that line. So they're not uncomfortable. They have nothing to lose by holding on to those positions until we come close to or break where their entry point was. And that's all that's happening with these ups and downs. So you got a bunch of shorts here to make this move happen. You got some longs in here. You know, they buy calls, they time the reversal, whatever. The shorts step back in, so you get another group of people pushing it down here, trapping the longs, okay? So everybody who was long here and didn't get out here is now stuck, losing money. So the longs come in because they're tired of losing, okay? You got all these nice wicks on the bottom of these candles, indicating some pressure to move to the upside. And again, once you crack each point of this coming down, you can see that at this level here would have been a good either resistance or turn into a possible support. In this case, it did. So we got the shorts that started here uncomfortable when we got back up to that price point. They either dump their positions, most of the time that's the case, and causes us to come back up. And again, we have another point here where you had some shorts coming in. They get uncomfortable when we break it. We run up a little bit. And look at how well that level holds. You got a bunch of things happening here. So every time we get up above a hump, you're making another group of people, short sellers or people in puts, uncomfortable, and they puke them up. That's what I'm referring to when I say puke. They're dumping their positions, which is causing SPY to move again. If they fight back, We come down a little bit, but the persistence, once you gain momentum, it just works out. But the most secure place to have done this is right up here where the majority of the people who went short caused this downward trend to begin with. Once you get at or above that price, everybody from here down is losing money if they were short. And what happens? They bail out of their positions and boom. This is what you call a short squeeze. Now this here was not a huge, well, this was a pretty good short squeeze. I mean, these candles are 5-minute candles. But at the end of the day, that is how this works. So if you're patient, it almost always works out. And if you look at a chart, you can start to see what I'm talking about. Again, here's a perfect example. Right out of the gate, about 10 minutes into the day, 5 minutes, you put in the high of day early, not high of day, but high of, that time. And when you come down from there, it's not safe. It's not a smart move to get back in until you get at or at least very close to this point later in the day, whenever that may be. Because at this point, shorts are okay. They're either even or up a little. But look what happens when you break through that. Right here, these candles right here was the last struggle for them to keep the price down. You had some upward pressure based on these wicks below, smaller wicks up top, which means the buyers are winning, and you're pushing the price up. And then they get uncomfortable, they bail out of their positions, and boom, there we go. It repeats itself over and over and over again. Same thing to the short side, or the long side, sorry. If you get here, there's no reason that you would be buying calls. I mean, you could have got trapped here, because we had the high of day was all the way over here. We got up to that point. They tried to break out. They tried to break out twice. If you got into calls here and you saw these two wicks, that would have been a solid indicator to get out. So you wouldn't have lost a lot of money, but they tried to go high twice back to back and it got pushed down massively. You would have gotten out there, probably could have reversed quickly and got into puts, because that's some serious selling pressure right there, keeping it down. So again, we're digressing, but gaps, they almost always fill. You just got to learn how to play them and when to get in to maximize your profits when playing them. I hope this was helpful. If any of you guys have any questions or concerns or ideas for other videos, please message me. If you want to help support the channel and become a patron, I will have a link in the description below. We trade SPY every day. We use options to do it, and a lot of us are being very successful with it. So if you'd like to learn how to do it the way we are, reach out to me. Join our Discord, and let's make some money. I will talk to you guys soon, and we'll see you in the next video. See you.